Hello, everyone. Welcome to today's live market analysis webinar with me, Fawad Razaqzada, market analyst with Think Markets. My colleague Victor is going to join us shortly, so it will be the two of us presenting today's webinar. Thank you for those of you who have joined us. For those of you who are watching a recording of this, please consider joining us live next time. Now, the reason we always say join us live is because you'll have the opportunity to ask us questions in the webinar. So for those of you who are here, you don't have to wait until the end of the webinar to ask questions. You can ask questions as and when we present live charts for you guys. Before we share the charts, please have a read through the disclaimer. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, as we cover in these webinars every Tuesday, 11:30 London time, we will discuss the major currency pairs, indices, gold, and cryptos if we have time as well. And then there will be a Q&A session at the end as well. So that's the general format of this webinar in case you're new to this. We go straight to the charts and discuss everything there. So without further ado, let me just bring the charts up. And there we are. Okay, so as you can see, the dollar has rebounded from this key support area. This is the daily chart of the dollar index. I can show you this on the weekly. Now the dollar has started the new year on the back foot, right? So this is the weekly chart. Despite the fact that inflation is surging in the US and bond yields are on the rise, we haven't seen any significant rally in the dollar beyond where it was at the end of last year. And part of the reason for this is because, two reasons really. First, other bond yields have risen as well. For example, German yields have risen, UK yields have risen. So expectations are rising that interest rates are going to rise, not just in the US, but elsewhere as well, as the global central banks try to tame inflationary pressures. Secondly, the fact that the dollar was already on the rise for much of last year. There's a bit of profit taking as well, which has caused the dollar to pause. Nonetheless, I reckon the dollar is still head and shoulders above above most other major currencies in terms of strength, owing to a more hawkish central bank in the Federal Reserve than any other major central banks around the world, including the Bank of Japan, of course, European Central Bank, the Swiss National Bank. These are among central banks that are considered to be a lot less hawkish than the Federal Reserve. And so for that reason, I reckon the euro dollar is going to weaken further, and the dollar Swiss is likely to rise. And I think my colleague Victor has just joined us. Am I right to? Yeah. Hello, Victor. How are you, mate?
Hey, very good. Very
excellent. Excellent.
Sorry for being a touch late here, but what I can add to what you already said is that last week during the confirmation hearing of Leo Brainard, which is the vice chair, which is nominated for vice chair of the Federal Reserve. She got nominated basically at the same time when Jerome Powell got nominated for his second term. She actually came out quite hawkish, and this was the point when the dollar turned. Because Leo Brainard is considered to be one of the most dovish members of the FOMC. And when she came out and said that inflationary pressures seem to be getting out of hand. At that time, the market reacted swiftly and started buying dollars again. So this is I don't like I'm not saying anything, but this cue from the market was pretty instant that perhaps we have gotten ahead of ourselves in selling the dollar. And
Right.
by the way, at the same time, I read this headline on Bloomberg. These headlines in the media are always so spot on. The headline was most currency desks are shorting the dollar. so you know that when that happens, it's time to buy it. And
Right.
yeah, I'm not saying like this is not investment advice, but
Yeah.
again, if you start paying attention to these headlines, you'll frequently see that mainstream media comes to cover positioning precisely at the wrong time. So
Yeah, it's always they're always behind the curve, the financial journalists, because
yeah,
they usually write about things that have happened rather than things
already.
that are likely to
Yeah,
happen. Yeah, and we, on the other hand, we obviously try to cover what's happening right now, but
yeah,
as analysts, our job is to forecast and predict what might happen in the future. And
yeah,
as for example, the euro dollar was rising in our previous webinar, you may recall that both myself and Victor, we were thinking that the rally is not going to last very long, and that it's going to turn around in this shaded region because of this being a major resistance and support in the past,
yeah,
and that the macro backdrop didn't support the euro dollar recovery, which
yeah,
is exactly what's happened, right?
yeah. And if you look at the dollar, it has rallied across the board, really. So
Yeah,
this is important when you I mean, if it was only the euro,
yeah,
it would still be questionable, but it has rallied even against the pound, which has been the outperformer this month by
right,
far.
yeah, yeah,
So yeah, and also like key technical levels, 200-day moving average, and trend line that actually not the one that you have drawn,
okay, so
but
there's a better
another
one.
one. Yeah, you can go back to the daily.
Okay, the daily one. Okay.
Yeah, you can go back to the daily and draw one from August, basically September. Oh, July. Yeah, sorry.
Sorry, it's from July.
Yeah, yeah,
This one.
yeah. This
Yeah.
peak, from July through
Oh
August
yes.
through, yeah, basically that's the trend line that stopped this move alongside the 200-day moving average, which, as we know, is always a very strong level.
Yeah.
So yeah, if we speak about the pound, despite the fact that it's the strongest currency and that the Bank of England is already on a hiking cycle, the dollar is still in demand because
Yeah.
it's the global reserve currency. And I don't know if you have noticed some headlines out of China this week, yesterday and today.
Okay.
Yesterday, the Chinese central bank actually eased rates for the first time
All right.
in 2 years. So they started an easing cycle.
Hmm.
That's something of surprise move there, because we are heading towards a tightening cycle in the western side of
Yeah.
the world. And Xi Jinping came out with an interesting statement saying that um, the powers that be, so look, I'm not going to be literally quoting him, but
Yeah.
the sense of it was the powers that be should not be over tightening monetary policy.
Okay, that's really
So
interesting.
the status quo remains that the US currently has the best weapon of them all, and this is the monetary system.
Yeah.
That's the only thing that is apparently worrying China at this point in time, because they have a lot of debt which is
Mm,
denominated in US dollars. And as the property sector continues collapsing down there in China,
yeah.
some debts are maturing, and even the most profitable and most solid property developers in China are seeing their yields, the yields on their debt rising.
Right.
So that's something that
And that's because of the rising US yields, making borrowing.
I would assume so,
Right.
and because of the fact that uh, the Chinese property market,
Right.
ladies and gentlemen, is the largest asset class in the world.
Seriously.
Uh,
Wow.
yes,
Wow. I didn't know that. So that's
66 trillion dollars.
wow. That's huge. So as you
Yes.
spoke, I drew some lines on the weekly chart of the dollar Swiss, not Swiss, dollar Chinese yuan. Um,
Yeah.
and this is the weekly chart showing a falling wedge pattern, a potential falling wedge pattern. So we need to see rates break out of this in order for the dollar against the Chinese currency to start moving higher, as the PBOC, the People's Bank of China, has started to loosen its interest rates. So this is
Yeah.
something to keep an eye
So
on.
yeah, that's definitely something to keep an eye on. And the yuan has been relentless in its
Yeah,
rise.
yeah,
Sorry, just to correct myself, it's not 66, it's $62 trillion. Just
right.
for comparison, the US fixed income market, which is the second largest asset class in the world, is
Mhm.
about $48 trillion.
Right. Okay.
So as of right now, there is 11 trillion worth of Chinese property, which is inventories. So yeah, I think we have a serious problem in China. Many commentators have been warning about the Lehman moment in China. It
Mm,
seemed that last year we had the Bear Stearns moment in China, with smaller property companies such as Fantasia and Evergrande
Evergrande. Yeah.
facing issues. And now we're coming to the largest property developer in China,
Which is
Country Garden,
okay.
uh, whose bonds have recently collapsed. I mean, just today, it's crashing big time.
Right.
It's
And is that why we are seeing some risk off coming through into the
Yes,
market?
yes, I would assume so. At that, and something that also crossed my headline scanner, the headline
Yeah.
scanner in my head this morning, was that China is actually considering, or some regions have banned outside mail
Right. Right.
because
That's
of COVID.
oh
Well,
wow.
I thought like, I felt like I feel like this has been debunked. Like COVID is
Yeah.
not transmitted on surfaces.
Yeah.
A long time ago, we are well aware that this is not happening, and obviously this is Chinese propaganda,
Yeah.
which is trying to justify and find a way to contain the small outbreaks, or so they say,
Yeah.
of new cases in China, and they keep on committing to their zero COVID policy. How long is it going to last when countries like Australia and New Zealand, despite their island isolation, couldn't
Mm.
couldn't really sustain this policy of zero COVID cases.
Yeah, that's really interesting thing to keep an eye on, because obviously if China pursues with its zero COVID policy, it's going to hurt the world's second largest economy, and that in turn should have repercussions for the rest of the world. So let's hope that we don't see further major lockdowns in China and elsewhere, and that the global recovery starts to steam ahead. But
Yeah.
in regards to what's happening today in the markets, as you can see, there's lots of reds here. And I've sorted this by percentage change, and you can see that the German technology index, the tech DAX index, is leading the declines, followed by the Nasdaq, another technology heavy index. This is Nasdaq futures, by the way. So what's happening here is, in addition to everything that we've discussed so far, it's this really that's causing investors to worry. We have seen bond yields
Yeah.
across the world break higher. In the US, they have now climbed to a new high for the year.
So how about the spreads between US and Germany? Yeah. Do we see any changes there?
So not really. I would say it's not. It hasn't moved significantly. This is the 10-year spread between German yields and
Yeah.
US yields. Let me just make this into candles. So German yields have been underperforming in recent trade, but they have been rising nonetheless. And the fact that they've been underperforming explains why the euro dollar has weakened, right? So whenever so basically the US yields are rising at a faster pace than Germany.
Than Germany. Yep.
Yeah.
Yep.
And hence why the euro dollar is come down a little bit. But yeah, looking at the German bond yields, they're still below zero, but it's a matter of time now before it breaks 0%. I reckon. It looks like the markets have
wonder
made up
how
their
high
mind.
inflation should be for this to happen.
Yeah.
Just joking.
Inflation is
Making
quite
fun of
high.
the bond market. Don't mind me.
It's a dysfunction of the markets. No way German yields should be this low. If it wasn't for the intervention of the ECB, we would be talking about yields in excess of maybe 1.5–2% for Germany. But they're being suppressed. Yields are suppressed because of continued buying of bonds by the ECB and obviously other major central banks in their QE programs, as part of their QE programs, I should say. Anyway, yields are on the rise. That's the main takeaway point that I'm trying to make here. And when yields are rising, and in the US, you can see that they've risen to, what's this level? They've risen to above 1.8, reaching almost 1.86 earlier today. When yields rise, this weighs on the appeal of stocks and
of
other
risk assets.
Risk assets in general, but specifically those that have low dividend yields, like the technology sector. Technology is growth, right? So people have been
like the eternal growth sector that that has been seemingly unfazed, going through unfazed with rally after rally. However, this dip here that we're currently experiencing seems to be a bit different. How do you look at this chart?
I'm not really too sure. I think
you're
on the
not
one hand,
sold on it yet.
not sold on it yet. No. Yes, it's testing this. Pun it's trying to break through this trend line. yet at the same time, we haven't really seen a proper breakdown, and we're still above the 200-day moving average. So, for all this, could be it may just be a pause, a long-term pause before we see buyers step back in. The reason why I'm not sold on this, so to speak, is because we're seeing major indices trade quite differently. There's a very sharp contrast between how the major indices are trading at the moment. So, for example, look at the FTSE 100. Okay, FTSE only yesterday hit only this morning hit a new high for the year before pulling back. And if you look at Spain, for example, testing the 200-day moving average after a really strong recovery. South African stocks, despite all the troubles in South Africa, it's still near record levels.
Right.
And in
So
Australia, we're not very far off the record there. So the point I'm trying to make, this is the French index. The point I'm trying to make is that I would be more bearish on this Nasdaq index had we seen more global indices, struggle the way the Nasdaq is. I know that the Nasdaq is a technology heavy index, and that's why it's not doing really well at the moment. So the way I would trade indices is I would look for long setups still in the likes of the FTSE and those that have lots of value stocks, rather than short the Nasdaq, because the overall trend direction in the global market still positive. So I wouldn't actively look for long setups in the Nasdaq because of the very high yields, but the fact that it's not a complete risk-off environment, I would rather buy dips in value names and value indices or value-heavy indices like the FTSE than sell the Nasdaq 100. Does that make sense?
yeah, totally.
Yeah.
I wanted to jump in here with some of the indices that you mentioned.
Mm.
So the FTSE is basically it's now it's the revenge of the FTSE, because it's
Yeah.
mostly a value focused
Yeah.
value focused index, and it
Mm.
has been underperforming throughout this
Yeah.
rally
Look at
since 2020 all the time. Like FTSE barely moved. There was so much so much really, like, so much frustration how the
yeah.
FTSE is the only index that is not making new highs throughout last year. Like, it was stuck in this range
Yeah.
between
This range. Yeah.
7,200 and 6,800. So now it's outperforming, and
Yeah.
finally we're seeing these
Higher highs
value
and higher lows.
companies outperforming and continuing, and obviously the commodity sector, which is also
Yeah.
you mentioned the South African index, and
Hmm.
obviously
Australian.
that's and the Australian one.
Yeah.
Obviously, those markets are heavily focused on commodities. So
Yeah.
uh, since those have been outperforming, I'm sorry, it's pretty, pretty pretty self-explanatory
Yeah.
why we're seeing the moves that we're seeing.
Indeed.
But yeah, let's speaking of commodities, let's have a look at
Sure.
that market.
What are
I
we looking at?
saw some interesting moves in copper this morning. It appears to be tapering its rise, and a breakout that happened late last week has now been invalidated, I would say.
This breakout. Yeah.
Yeah, triple top that was probed, and the price actually closed above it for a day. No, actually for 2 days. I'm sorry.
Yeah.
This I think it's worth paying attention to this chart if you're trading commodity currencies like the Aussie, the Kiwi. So yeah, we're seeing some pressure on the copper market, and there is quite a lot of uncertainty at this point in time in the market, while we get to a conclusion whether we will see 2% yields, which will definitely be a big hit for the stock market.
Sure.
Just seeing
Copper
that number
is still above the 200-day, around the 200-day moving average, and it's been quite ugly price action in recent past. It's a very difficult market to trade when price action is doing this sort of action, when price is doing this sort of action. So we could still see copper turn around. I think this is the key turning point, or the line in the sand for me. This black line here at 4.30, which was the last low created prior to this move up. So although the early signs are not good in that it has, as Victor mentioned, failed to hold the breakout, there's still hope, because we are still testing the trend line and 200-day moving average. But if it goes below this level here, then I think all bets are off.
Yep,
Yeah,
pretty much.
Crude oil, on the other hand, is
oh my god.
Yeah, I mean, I'm trying to find UK. Oh, there you go. It is testing or breaking even the high, or the highs, I should say, from last year, as well as 2018. This level here was hit in October of 2018. We visited that level in October of or November of last year. Yeah, we sold off there because of concerns about Omicron variant of COVID that could, we thought oil was going to go sell off sharply from there, and it did. But the rally has caught many people by surprise, including myself, because obviously it hasn't turned out as bad in terms of its impact on the economy, and death rates have been low, as had been feared initially. So people who sold oil because of concerns about demand falling and stuff, they were proven wrong, essentially, and oil prices are back to levels and surpassing those levels that they were trading before the emergence of Omicron spread. At the same time, we are seeing some OPEC countries like Libya struggling to produce the agreed limit of oil under the OPEC Plus agreement, who have decided to continue with their gradual increase of oil production by 400,000 barrels a day. But at the moment, the OPEC Plus is not producing 400,000 barrels a day. They produce a lot less than that. So the compliance among them is about 120% at the moment, meaning that the OPEC Plus is not producing as much oil as they had agreed to, which is 400,000 barrel increase per day was less than what was kind of needed insofar as bringing oil prices down, and that's what the likes of US and India and other oil consumer nations were calling for the OPEC to ramp up production faster. But the fact that they did not ramp up production faster, and they struggled to even meet their own target of 400,000 barrels per day, means that supply of oil has not gone up as quickly as the market was expecting, and demand was not hurt as severely as the market was expecting, and so therefore prices have gone up. But where do we go from here, Victor? That's the key question.
So in my well, we're at this point where we're marking a new high, and
Yeah,
if history is any guide, we might be close to the peak as well, because
yeah,
we had the same type of move in April and May, when we had a correction from the high, which was followed by a higher high and a higher low in September, in August, July, through September.
yeah,
And then we had another higher high and another higher low at the end of last year in
yeah.
October and
Then it's all up.
November.
Yeah.
So yeah, now we're getting to another phase.
Mhm.
I feel like at this point in time, the market could be getting a bit ahead of itself.
Mhm.
So another correction, I feel is I would be cautious in. I mean,
Chasing longs here. Yeah.
I wouldn't be buying oil at these recent
Yeah.
highs. I
So
would be waiting
what is
for a dip. So
specifically maybe Victor and I would be looking for is possibly something like this. Okay. I'm just drawing what do you call it? A candle on the daily chart. The sort of candle that we look to see before selling oil. Something like this, an inverted hammer maybe. Not necessarily today, but it could happen in the next few days. Something like
yeah,
that to bring us back below the screen level here.
yeah,
And if we see that, that would strongly indicate the formation of a
exhaustion.
exhaustion and a reversal stick. In which case,
Yeah,
we could see oil prices come back down to like levels such as this, which 80 at around 82.90ish, which was the point of origin of the latest move up. So we could retest that level before oil decides on its next move, which could be up or down, depending on the fundamentals at the time. But from a purely technical point of view, sorry, let me just get rid of this fib extension. Yeah. But from a purely technical point of view, something like this would be a short-term bearish development. US oil is also pushing higher. Inventories in the US have been falling, crude oil inventories, and that's usually a sign that demand for oil is strong. Um, it remains to be seen whether or not WTI will be able to break its corresponding high. Well, we did test it this morning, didn't we? The high from last year at 85. 85.40. We poked above it, and now prices have come back a little bit back below. So keep an eye on this chart as well. If you trade crude oil, make sure you're watching both Brent and WTI because they tend to move in unison along with each other. And so right now, WTI is also testing resistance. Let's see if we fail at this breakout or breakthrough.
sorry.
Bless you.
Yeah,
So I haven't looked at the chart of gold, but I would imagine it would be lower because of rising yields. Gold is really struggling to break out this key area of resistance, the shaded
yeah,
red region. We've tested it a number of times in the past. Finally broke out in November, but then it was slammed back down. We tested it again in December, and yet one more time in at the start of this year, and this week or last week again. um, Gold traders try to see uh, how strong or otherwise resistance was at around that level. But the only thing I would say here, Victor, is that the more times a level is tested, the more likely it will break in the direction of the test. So should we come back up to retest this level, perhaps at that, third time of asking this year, we might see a breakout and head towards 1860, possibly 1877, the high that was created before the drop. That's something
yeah.
that might happen, right?
I will be also re-emphasizing my bearish stance that the 1682 level that you have on the chart has been tested 3 times, and
Yeah.
could also serve as a magnet, and a head and shoulders formation is on the cards with
Right. Left shoulder
yeah,
here.
left shoulder, right
Head.
shoulder, show above 1860.
Yeah.
And we tested the 1830 area 2 times. So yeah, let's see how this unfolds.
Yeah.
It's really a two-way street.
Yeah.
No definitive calls to make here,
Yeah.
except for the fact that we've been speaking about this dollar strength, and yeah, that's the real driver here, at
Yeah.
least for now. Although the dollar, you couldn't say that the dollar has really strengthened against gold. It's been
Yeah.
trading in a narrow range between 1830-ish
Yeah.
and 1810 for the past 5 trading sessions.
Yeah. Also,
So
it's kind of held its own relatively well when you
yeah,
think about bond
it's
yields
if you
breaking
look
out.
at, if you compare it to currencies,
Yeah.
I mean, yeah, the gold is definitely shining brighter than other major FX.
And there's some fundamental reason behind it, isn't it? Because gold is seen by many investors as a real hedge against inflation. And when you
Right.
see inflation rising to levels not seen since the 1980s in the US, and at record levels insofar as the eurozone is concerned, then perhaps it makes sense for investors to have at least some exposure to gold as they seek to protect their wealth from being eroded
Yep.
by the value of fiat currencies, which are losing value left, right, and center because of inflation. So that's one reason
Certainly.
why gold has held its own relatively well. Yet at the same time, it's surprising, not to see gold surging higher at times like now, because if gold was a true inflation hedge, why isn't it breaking
Right.
out significantly?
If not now, when?
Exactly. This is it, right? So this is your chance, gold bulls. You've got to show us what you got, and break it.
I just want to say here that I'm still not convinced that we are yet to that we are to see a gold rally, just
Mm,
because of all the fundamental backdrop and the
yeah.
fact that we haven't seen real flushing of stops
Yeah.
on the downside, like 1682, this
That's a
triple
big level,
bottom
isn't it?
there.
Yeah.
Yeah, this oh, sorry, yeah, it dates even longer
Yeah.
back
Let me show
towards
you on the weekly chart.
yeah.
It goes all
So
the way back to June, May even,
yeah,
2020.
and you can say that it was uh, the post-pandemic crisis
Yeah.
moments that marked a peak around 1700. Then risk assets sold off. At that time, risk assets were selling off, and gold
Yeah.
was holding its ground.
Mm,
And it's really an important level. I can't see us not testing, probing, making a probe below this level,
yeah.
just to clear out some stops in order to open the way for another long-term
Move up.
trend
Yeah.
higher.
Yeah. Standing on the way of that potential big drop is this bullish trend line that goes back all the way to August of 2018. Yeah, it's not
Yeah,
a clean trend line because it goes through some bodies of some candles and so on. But technical analysis is never meant to be exact science.
Yeah.
And this trend line is
It's actually akin to dark science.
yeah, indeed. This trend line is still holding, and we may be breaking out of this bull flag as well. We've attempted to break out here, but that was quickly sold off. Um, didn't hold there. We broke out a few weeks ago, retested the flag trend, and then we bounced from there. And so far, we are holding the breakout on the weekly time frame. So as price continues to converge between resistance at 1834 and a trend line, which is rising, we are going to see a breakout in one or the other direction in the next few weeks, if not earlier. So depending on the direction of the break, we could then see a prolonged move in that direction. Now,
Right.
as Victor mentioned, it appears like the risks to the downside are greater because of the dollar rally, because of rising yields, because of central banks tightening. The only hope for gold is inflation, and so long as inflation remains elevated, then the downside is likely to be limited, as investors seek to protect against rising prices by investing in gold. So that's the two kind of major conflicting factors supporting and weighing on gold prices. So in other words, gold is stuck between a hard place and a rock. The rock being inflation, providing its support, hard place being all the central bank tightening and rising yields and stronger dollar.
Yeah.
Let's move on and look at a few cryptos, shall we?
Okay. Yeah, that market is has been taking a beating
Yeah.
over previous weeks and has been stuck in a range for the past just well the tight range of $4,000.
40,000. Oh,
No, I
$4,000.
mean
Oh, the range, yeah.
the tight $4,000 range in Bitcoin, which is about 10%
Yeah.
of its value.
That's double the value of gold.
Yeah, the 10%
10,000.
range in cryptos has been holding for the past 2 weeks,
Yeah.
and we're still flirting with this trend line, long-term trend line, very long-term trend line, and a double bottom at the same time around 40,000. So yeah, how do you feel about this? I guess the same way as with the Nasdaq, like it's
Exactly, yeah.
almost there, but
Not
it's still
quite.
not
Yeah.
happening.
Yeah.
And when it happens, it might be too late to act, because if
Exactly,
it
yeah.
breaks through, it's going to be so sharp that
Yeah.
yeah.
So yeah, I mean, generally speaking, I don't like shorting anything, especially cryptos, because of the nature of their moves. But we haven't seen a confirmed low yet in Bitcoin, I don't think. Yes, we created this. I'll highlight in a minute or so. Let me just draw this trend line first. We saw this doji candle at 40,000 a few weeks ago. The only reason it's not looking so bullish now as it did then is because of what's happened since. We haven't seen immediate follow through on the upside.
Yeah.
Yes, prices did rise for the next 2 or 3 days, but then Bitcoin struggled to sustain that move higher, and we've now gone back below 42,250, which was the high of that doji candle. So we need stronger evidence of a bottom before one can become more bullish on Bitcoin. And for me, if we don't see that in the form of price action around these areas, then what I would like to see is continued sideways trade, but in a sort of upward trajectory that would eventually take us above the opening level for the year, which is this purple line at 46,200. So if we move above that eventually, then that could be a sign of a bottom as well. But yeah, 40,000 is essential to hold. If it doesn't hold, then we could see more pain for crypto enthusiasts, not just for in Bitcoin, but other coins as well. Guys,
Right.
are there any questions for those of you who are in this room? Any questions, please ask now while we discuss cryptocurrencies. Anything else is catching your attention, Victor?
I don't think that there is something that we haven't covered. Yeah, the key to this markets will be the bond market.
Yeah.
If this rally in yields continues, we might see some pretty rocky times for equities and a stronger dollar and even a stronger yen, just not against the dollar, perhaps.
So the key level is 169. 1694. This level here. This was the last low before we saw this move up. So for as long as we hold above that, the trend direction would still be bullish for yields. And then in that scenario, we would continue to favor looking for long setups in value stocks and indices that are dominated with value stocks and banks, so such as the FTSE, as we mentioned at the start of the webinar. Yet we wouldn't be very keen on low yielding assets or assets that pay no interest or dividend, like gold. So it's all being driven by the financial markets are being driven by the bond market right now. So just try to take the trades that make more sense to you rather than anticipate anything. Go with the flow, go with the trend direction, and take it from one level to next and move on to the next opportunity is how I would approach the markets as they are right now, regardless of which asset class you trade.
Yeah.
On that note,
in any case, stay safe out there, and we will speak again next week.
Next Tuesday. Yeah, that's correct. So thank you so much for joining us. And for those of you who are watching a recording of this, just let me remind you that you can join us live by going to thinkmarkets.com, and then from there, go to market analysis and live webinars. Once you're in that page, you can click on the button to register. For example, this was today's webinar. You could have clicked on register, and then from there, you can put in your details. Okay, so that's how you join us live next time. Take care, guys. Have a wonderful week ahead.
Take care. Bye-bye.